everybody, and welcome to accounting. So this is going to be for to do accounting for as if you're starting from square one and you don't know anything about accounting. Okay, so this is me giving you an introduction to accounting. All right, so let's start off with the very first thing is what topics we're going to be covering in accounting. So again, we talked about this very briefly, and I will go into more details when we reach the end of this PowerPoint, but we are focusing primarily on understanding the flow of transactions and how these transactions affect a business and how do you even get your business started. Okay, so we will be looking at the basic principles of accounting, all right, and which is going to be collecting, recording, journalizing, and posting, and creating balancing, trial balances, and et cetera, et cetera. Okay. Another thing that we're going to be looking at is the accounting equation. The one thing that governs all accounting is the accounting equation, and making sure that the assets equal the liabilities plus the equity. Okay. Other things that we're going to do is we're going to be looking at the rules that govern all of our accounting here in America. Okay. So again, understanding why do we generalize these things? Why it doesn't have to be a certain way, and it's because of Acct, and we'll talk about that in chapter 4. Okay. And because we are going to be looking and diving into a specific business organization, our main focus is we're going to be looking at a retail store or a merchandising operation. So we're going to be looking at how to make purchases, how do we make sales and revenues. Also, we're going to be looking at how to collect those sales, okay? And other things too is we're also going to be looking at creating a financial statement, which we'll talk about towards the closing process, which is going to be the end of the course, about around week 13 or week 14. All right. And lastly, of course, with all businesses, not only do we have our customers and our vendors, we also have to focus on, well, what if you need to have employees? It is very important that when you run a company, you can't run it by yourself. And even if you manage to do it by yourself, it is a lot of work. So having employees to help you out is probably the most essential thing that you can do. Okay, so we're also going to be looking at payroll. Okay, so first things first is going to be looking at business organizations. So when we look at business organizations, the main goal is looking at the nature of a business, which is using all of our resources to create a good product, goods, or service, okay? And that is the main goal. Underlining a definition of that is the number one thing is the goal is to just make money, okay? You want to make sure that you minimize costs and maximize your profits by, again, if it costs you $1 to make an item, but you can turn around and sell it for $5, then you're doing good in business because you're maximizing your profits and lowering your cost. All right, so the true thing about the nature of a business is just to make money, okay? And also maximize the savings as well. So, yes. So we're going to be looking at 5 different types of businesses. So we have our sole proprietors, we have partnerships, we have our corporations, we have our limited liability companies, which is an LLC, and then lastly we have our non-profit organizations. So these are the 5 major business organizations that exist today. So and they're pretty they're pretty straightforward when you want to kind of understand the nature, when you understand and apply the nature of business. And it also is like, especially when you're starting your business, it's kind of like a train. It's kind of like a hill that you have to achieve one another and start establishing somewhere, then become something bigger. Okay. So we're going to dive into each and every single one and what their advantages are and what their disadvantages are. So let's go ahead and get started. So the very, 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 very first one is going to be a sole proprietor. Now, this is the most common and easiest form of business that you can create because all you need is just one person. So when we talk about people starting up small businesses or having a startup company, hold on, let me check something real quick. And we want to just have, or it usually starts with an idea. Sole proprietor is only one person. And when a sole proprietor establishes a company, what happens is the owner and the company are one, okay? Meaning every decision that this person makes is solely his decision, meaning he has to also, or she has to also realize that there are consequences to every decision that he makes. So whether it's a good decision or it could be a bad decision, okay? So just understanding that a sole proprietor, right, sole meaning one, is primarily just one and one person only, okay? That's the only criteria. A little fun fact here is that the IRS will, for many reasons, they are boggled down on sole proprietors. They are the ones who kind of look at them and see if they make a profit or not. Now, the rule here, it may have changed, but it is a general rule of thumb, and it's a little FYI that if you are a sole proprietor, if you do not make profits, okay, 3 out of the 5 years you do business, you are technically considered a hobby, okay? And this goes a long way because especially when you are a sole proprietor of a business, you get a lot of tax breaks, okay? But if you don't make any profits within the 3 years of the 5 years of doing business, the IRS is going to recognize that this company is a hobby. And what happens is when it becomes a hobby, you don't get those exclusive taxes because it's not a real business. It's just something that you enjoy doing. So that is one of a downside when it comes to creating a business on your own. Okay, so what are the advantages and disadvantages of being a sole proprietor? Let's talk about the advantages first, okay? So the first one is, again, it is the easiest way you can form a business, okay? All you have to do is go down to the state or local agency, apply for a business license, and you have to pay about maybe like $100 or so. And 30 days later, boom, you can get approved and get your business license right then and there. So easiest form and easiest way to build up your, to create a business is go sole proprietor. You just have to go to get a business license and boom, you're ready to start business. Okay? And second thing is the owner has true control of making all decisions to run the company. So this is a good advantage because oftentimes when you have someone else that's also in your party, you have to make a fair decision. In this case, you can dictate and be able to make all the decisions and be able to control the business however you want to run it. So you can get ideas from other people, but ultimately the owner is going to make full decisions on every single thing that you need to run the business. Okay. Other than that, another thing is that as a owner of the business, not only do you get to invest in your company, every single penny that you earn for a profit, you get to pocket all of it. Okay, and we'll talk about this when we go into when we dive into our little case study after the first 10 weeks. We're going to look at why it's not really suggested to pocket all your profits. It's actually better if you reinvest it, especially if you're starting from scratch. Okay, and we'll talk about that. And then number 4, personal tax deductions. Yes, as a sole proprietor, since you and the business are one, again, the biggest advantage is you get a huge tax break. Okay. And what I mean by a huge tax break is you can write off a lot of things, you can deduct a lot of things, and basically you pretty much get most of your money back when you file taxes. Okay, so it's a huge, huge, huge tax break, and yes. Okay. And then lastly, it is very easy to dissolve. Since you are the only person that created the business, you are also the one that can easily just throw it away. All you have to do is report to the state and local agency that you are closing. You close up your bank account, rip up your business license, and boom, that's it. That's how easy it is to just create one of the business, and you can just dissolve it. It's that easy. Okay? Any questions on the advantages of being a sole proprietor?
What is the meaning of the word hobby?
Hobby. It's something that you enjoy to do. I'm not quite sure if I can describe it. It's for example, maybe you open a skateboard shop and you like to skateboard. You buy all the things, and then what happens is instead of trying to make a profit, and you take a loss every time, and you're just selling your products because you enjoy it, instead of rather than make it into a business where you're trying to make money. So a hobby is something that you enjoy to like, or you like to do, or enjoy to do. Okay. Any other questions? All right. So now that we talked about the advantages, disadvantages of being a sole proprietor. That means 100% responsibility for making all payments and liabilities that you owe. So, what does that mean? Again, since you're the sole owner of the business, every decision that you make can be a good decision or it could be a bad decision. So in this case, if you make a bad decision, you as the owner must assume all responsibilities in regards to that bad decision. So let's say you took a bank loan and you decided to splurge on that bank loan and put it somewhere else, and your business isn't making any profits and you can't pay the bank. Well, you're responsible to pay that loan, no matter what it is. Okay? So, with that being said, that means number 2 is that all personal and business assets are at risk. Meaning, if once you make that bad decision and you have to pay back that loan, first, because you are 100% responsible for everything that you, for the business itself, first thing is they're going to do is they're going to go after your business assets, so liquidate everything there. And then if it's not enough, they go after your personal assets. So If you ever seen those movies where a businessman, they get all their possessions all repossessed by the bank, that is often due to a bank decision or a bad decision, a business decision that caused, you know, that you owe so much money that they take back everything that you own. So that is one of the downsides of being a sole proprietor. Okay. Number 3 is limited to using personal savings and consumer loans. So as a sole proprietor, right, you and your credit score are one. So just exactly how you and the business are one, everything, especially when it comes to starting your company, you have to either invest your own money, so your own savings, or you could get one of those little personal loans for your business. And usually there's it's a personal loan that is meant for your personal business. It's not really two separate things because again, you and the business are one. So that's the only thing that you are able to receive is a small consumer loan. All right, and oftentimes those interest rates are very high. Okay, and then number 4, and it doesn't attract high caliber employees. Okay, because, and we'll talk about this when we go into payroll as well. When you're a small company, when you're a small company, it takes a lot to have employees. And oftentimes, if you're a small company, you can't afford those benefits to provide for your employees. So that makes you less desirable to want to work there. So most employees that work for a sole proprietor, usually they're either like, people who are starting out their first jobs, or usually just people who are just looking for any kind of job, but they're not planning to stay there long term. And the reason being is because you're working for a company that doesn't give you any benefits. So it just makes it less attractable to want to work there if in the long run you're going to get nothing out of it. So it doesn't attract high caliber employees for that reason, is because you're not getting any benefits. So why work for a company that doesn't give you benefits? So that's a downside. So you're going to have a lot of employee turnover. Okay. And then lastly, employee benefits are not fully deducted to the business. So again, when you do have employees under a small business or a sole proprietor, those benefits and deductions may or may not be able to apply for you. So depending on how big your company is, let's say your company, you're a sole proprietor and you only have 5 employees with 0 benefits, your tax deduction is not going to be very big for having these employees, because you don't even provide these benefits, which can be a tax deduction to you. So it's kind of a lose-lose situation here. So if you have employees, great, but you can't provide benefits, then you're going to have less deductions. So that is the downside of just establishing yourself as a sole proprietor. You're very limited on what you can do, but again, and you're fully responsible for every decision that you make, whether it's a good decision or a bad decision. Okay? Any questions in regards to sole proprietors? Okay. So sole proprietor. Okay? And that is primarily what we are going to be focusing on for this entire rest of this accounting class. And I'll talk about it, especially because here we are teaching you from square one, as if you've never took accounting or even know accounting. So how we are letting you dive in is we're going to start you off with a small business versus a corporation, because corporation, there is a lot more stricter rules and guidelines that you have to follow, and even worse is like the major corporations. They have a big huge organization, umbrella organization. So you're going to be looking at pretty much at a microscope view and making sure that your accounting is extremely accurate. They cannot afford to make any mistakes. So when you go into a corporation, there's a lot more rules and a lot more details that you have to actually be very aware of. But for sole proprietor, it's very easy because I'm just showing you the very, very simple basics of just doing the bare minimum to be successful, to create a business and be able to do its books. Okay? So next section is going to be partnership. Okay? So partnership, there are two different types of partnerships. You have a general partnership, and then you have a limited liability partnership. So it's very common that you'll see or you'll hear LLPs. Okay? And that is what limited liability partnerships are. Now, let's go ahead and dive into what a general partnership, and then I'll talk about what the difference between the two are. So a general partnership is where two or more individuals are the owners of a company. So that means all business partners have equal, or however you establish it, of course, equal responsibility, but also equal positions to do the shared amount of work. Okay, so for example, PETA is owned by Lori Clemens and Steve Clemens. Okay, they are a partnership in this business, so it's both of them that have to do the work. Okay. And the great thing about that is that means if they are equally dividing the work, they are also equally splitting the profits. Okay. And then the difference between that and a limited liability partner, okay, is going to be at least one of the partners is the general partner. Okay, so this is where we've come familiar by hearing what a silent partner does. Okay, a silent partner, their only task and only duty is to either invest into your company and only take the amount of profit that they invested in. So for oftentimes most times that you have maybe one or two silent partners that aren't really involved in the company, but you have to have at least one of those partners be a full general partner, meaning they are the one that's actually fully running the business by taking care of everything that it needs. So you'll oftentimes will see most partnerships are limited liability, just because it is hard to establish a company by yourself. And at least this way, for those who are very ambitious, they have, I don't know, a relative that wants to invest into their company. They're going to run the business while their relative gets to just seek out the profits, but they invested money into the company. So that's just the difference between a general partnership and a limited liability partnership. Okay, so the rest of the partners are limited to their original investment and can only act as a silent partner in this transaction. Okay, so again, they're only limited to what they invest into the company, and that's exactly how much profit they're able to pull out of the company. So again, all of this is all logistics, and you have to agree to a certain percentage profit and split it however you decide. Okay. So, any questions in regards to partnerships?
No.
Okay. So, I'm going to go ahead and talk about the advantages and the disadvantages of partnerships. Okay, so one advantage is it's also, again, easy to establish. However, the agreements that are involved in the partnership is what takes the most time. Okay, so again, you can't be like, hey, my best friend, you and I, you want to start a company? All right, let's shake our hands on it. No, there's more detail into just coming up with an idea and be like, okay, we're just put our names on there. It's just like a marriage. You have to agree on what responsibilities you're going to be taking. You're also going to agree, well, what profits you're going to exchange. Or for example, if you have more than two partners, right, let's say you have a total of three, you have to distribute it somehow. Okay, you could split it right in the middle, 33, 33, 33, or you could actually make it 40, 40, 20. So it just depends on how you want to run the business. But obviously, you can't just go into a partnership with just saying, "Hey, you and I, we're buddies. Let's start a business." No, there's a lot more detailing into agreeing what responsibilities need to be taken, and what profits need to be shared, and what's your position in this organization. So it takes a long time to actually have to agree. And if you are very, very good with this, you would have legal teams to go into this and build a contract between you two. Okay. Other second thing is going to be ability to raise funds. So because there's more than one of you, one person could be, at home dealing with all the expenses. The other one could be seeking out all of those, funding things. So, such as going to go get loans. They might partner up with another organization that could do fundraising, some way to raise money. So, in this kind of sense, you're able to have a company, and with two people involved or three people involved, you can distribute it how the money could be pulled in. Okay. It could be like one person is in charge of this specific type of sale, while the other person is in charge of another type of sale. Okay, so pulling in maximum and ability to raise money. Okay. And also, you get a huge tax deduction for profits. Okay, so as a sole proprietor, you file taxes as if you write it off as if it's your own personal tax. As a partnership, you actually get a tax deduction for that because you're established as a legitimate company and the profits are actually split. So, with that being said, you get a bigger tax deduction when it comes to those kind of profits. Okay. Other things too is hiring employees that may have a potential to be a partner. So, this is more applied for if you have a business or a family business. Oftentimes, your relatives or your lineage doesn't want to take over the family business. So if there's someone that's in the company that's been working with you for a long time, it attracts it attracts employees because it's a possibility of becoming part of the company itself. So that is a very good advantage, especially for if it's a family owned business, right? You would entrust your close family friend to want to take over your business if in case your family doesn't want to continue it in the future. So that's a very good bonus because if you could become part of the company, yes, of course you want to work there. Okay, you would want to seek that potential. Okay. Other disadvantages of being in a partnership is, of course, you are responsible for each partner's actions. Okay, so if you guys are general partners, if one partner goes ahead and says, oh, I'm going to make a decision on behalf of my other partner. Okay, so yes, sometimes that partner can make a good decision or a bad decision as well. So the whole idea of this is if one partner makes a bad decision, the other partner has to suffer through that bad decision with them because you guys are equal on an equal playing field or whatever it is. Okay, now here's a little fun fact, a little tip here. If you guys are in a general partnership, if one general partner decides to hold a meeting and make an executive decision based on your behalf and you do not know about it, you can go ahead and revoke that decision because you were not involved in that discussion. Okay, so that's pretty cool. So if your partner is doing making executive decisions behind your back, you can revoke every decision that they make because both partners must agree on a decision. Now, if that person decides to run a meeting and calls you and says, "Hey, I'm making a decision to do this," and the partner agrees, then that is intact because both of you guys agree. You guys both know what the decision is, and you guys can proceed with your decision, even if it's a bad one. Okay, so little fun fact there. Okay. Number two, and I guess it depends on how you view this, but of course, profits are shared. Not many people like that idea, but I mean, it comes into reality when it comes to, hey, I need you for a reason. I need you so that I can be able to build my own company. Well, yeah, if you go into a partnership, you have to also agree to share your profit. So every dollar that you make is going to be split in half. Okay, so that's a disadvantage because you think your company's making a lot of money, but you don't actually get to pocket all of it. Okay. Another disadvantage is, again, when it comes to partnerships, you will have disagreements. It's just like a marriage, right? Not everything you're going to agree on, especially if your partner is like, well, I want to do this, I want to do that. And on your side, you say, no, that's a bad decision. It's going to make it a lot more difficult to agree on a specific decision, especially if it's like, oh, should we remodel our company? Should we create a new company logo? So again, two heads, they work better, but they also can butt heads very, very easily. So it's also good and bad that you are in a partnership because, again, you will have disagreements. Not everyone's going to agree on something. All right. And then you're going to also have some employee benefits that are non-deductible to the business. So again, this goes along with how many employees you have in the business. So if you have maybe 5 employees and you do provide some benefits, it's actually not going to be able to be tax deductible for that reason. Okay, so it just depends on this is going to be something that you have to go to the IRS and kind of figure out, well, what is my criteria in order to get a tax deduction. Okay. And then lastly, it is limited life as if the partner leaves. So again, the definition of a partnership is 2 or more people. Okay? Meaning if you have only one, obviously you're sole proprietor. If you have 2, then you guys are a partnership. If a partner leaves, well, you have 2 decisions. You either find a new partner or you reestablish as a sole proprietor. Okay? So, and this is where oftentimes a lot of smaller companies, they start out with partnerships, partners disagree, so then they start becoming LLPs. Is because you have one general partner and you're seeking that extra partner just so then you can continue running your business. And usually that second partner is going to be a silent partner. Okay, so that's a disadvantage to that, is that your business can crumble if you don't have another partner, if your partner leaves. Okay, any questions in regards to partnerships? Okay. Moving on to corporations. So, corporations is the most widely type of business entity that everyone recognizes. Okay. They are the big boys. Okay. They are the ones that generate the most income and they are the most profitable. Okay. Now, there are characteristics to establish or to have a corporation. Now, little side note to this is corporations don't come from the ground. They're not something that you can establish right away. Okay, unless unless you're trying to become a franchise or a licensed company, then yes, then that's fine. But most companies they have to start from either being a sole proprietor or a partnership or a limited liability company before they can seek corporate status. Okay, so of course, Target never was always incorporated. It took them a long time to finally incorporate. And again, you can't just establish a corporation right off from the ground. You have to start from somewhere. Okay, but the criterias or the I guess characteristics of a corporation is, number one, you need to have shareholders. Okay, you do you or a person in the corporation does not technically own the company. It's actually owned. It's actually its own entity. Okay, and how people, want to become part of the company is that they have stockholders, stocks, right? That just allows you to be a part of the company. Okay, and then of course the amount of ownership is based on how much percentage of stocks you actually own in order to be able to make an executive decision based on what the corporation needs. Now, of course, with that being said, there's a little thing called a central government, okay, or a central management that actually runs the corporation, and we call that the board of directors, right? And what the what the shareholders do is they have a meeting that's conducted every year to make those executive decisions. But the real people that actually run the business is going to be elected by the shareholders. Okay, so in another sense, this is kind of like a little central government that the people own the company, and the people decide who gets to run the company, and and then obviously the people who run the company makes these decisions, and it has to be voted upon the shareholders. That's how a corporation is run. Okay. Other second thing is going to be transferability of shares. So of course, we all know if you own a piece of the company, right? If you bought stocks or some kind of shares of a company, your profit is going to be through your dividends. Okay. And then number 4 is continuity of a life will always live beyond as long as there is only one shareholder. So think about it. A corporation is massive. But there's also times where corporations run out of money because they're just not becoming profitable. And when they become unprofitable, people start selling their shares and stocks, and then less money is actually going into the company. All right. So those are the 4 characteristics of establishing a corporation. All right. Now, of course, here's a little fun fact here. A corporation is a business that is incorporated in the state that they're headquartered in. Okay, so again, it's going to be based on the state that you establish yourself in order to become corporate status. So that's just a little fun fact there, that you are incorporated based on whatever state that your headquarters are in. Now, there's often times where you have headquarters number 1 and then the second headquarters. That's completely fine. Usually with that kind of thing, it's just because you want to expand to either the West Coast and the East Coast. So that should be okay. And again, with being incorporated, that's where you can also franchise and license other people to establish your business so it continues growing and growing and growing. Okay? So just a little fun fact there. So we're going to start off with the advantages of a corporation. Okay? Okay, so first one is that when you have the stockholders or the people who own the company or the shares of the company, you have limited liability, meaning that none of your personal assets are actually at stake. So if for some reason that the company makes a bad decision and puts you guys in a lawsuit, you guys are not responsible to pay any of it, whoever the stock owners are. It's purely the corporation because it's its own entity, meaning that means they need to pull some kind of money out of profits to pay for that lawsuit. So that is a very, very, very positive thing, because you can own a whole bunch of stocks, and if your company doesn't do well, obviously stocks, they change, so you can lose money out of it. But you don't have to pay anything. You're only subject to how much you actually invest in the company. Okay? Second thing is that shareholders are only held accountable for their investment. So again, if you own 40% of the company's stocks, then you are subject to losing that 40% of stocks. Okay? So you're only limited to whatever you invite. Yes? Go ahead. Nilo, did you say something?
No, I just reading the last.
Okay. Okay, so yes. So when we're looking at when we're looking at an advantage, you're only limited to what you invest. So if it's $1 for a stock and I buy one of them, you're only limited to that $1. So you could potentially lose that dollar, or you could actually gain money out of it. Okay, so that's a good advantage, all right? Number 3 is able to raise additional funds through the sales of stock. Yes, corporations make money not only doing whatever primary activity they are, whether they're a retail store or not. So if they have a second profit center, which is gaining all the money through their sales, okay. The best way that corporations actually do receive money is obviously selling their stocks. So there could be what we call split stocks, where you could get a deal where one stock can be, you could get 2 stocks for the price of one. Usually that entices people to buy more and more and more. So the more that people buy, the more money the corporation is actually receiving. So pretty straightforward. And then number 4, tax deduction for having employees. Yes. As a corporation, you can get a huge tax break because as a corporate status, you have a gazillion employees. All right, you can have anywhere from 50 to 100 employees. So again, we're looking at the business standpoint. If you have all these employees, of course you're going to get a huge tax deduction for it. Whereas for someone who's a small company that only has 5 employees, then yes, obviously you may not get a tax break there. So the more employees you have, the better you'll get a tax deduction. However, the more money you need to pay them and the more money you have to provide benefits for. So you're at a loss no matter what. Okay? And then lastly, you can elect to be taxed as either an S corp or a C corp. So this is where a lot of people get confused. They always associate a C corporation and an S corporation as 2 completely separate entities or 2 completely separate organizations. In reality, if you really boggle down to it, the only difference is how you're being taxed, right? So, and yes, you do need to establish this, especially if you're filing to the IRS. They need to know what kind of tax are you paying. Are you paying as a C corporation or are you paying as a S corporation? Okay, so again, C corp is being taxed twice. Not only are you being taxed at the corporate level, so any taxes for profits is going to be taxed at, and also employee taxes. Okay, individual employee taxes. That's going to be the reason why you get taxed twice. Where an S corp, you only get taxed at the personal level, meaning for your employees is what you're going to get taxed on. So that's the only difference. So one, you're getting taxed twice. The other, you're getting taxed once. And most corporations, they actually gear towards the S corp because obviously no one wants to pay taxes. So they want to try to minimize as many taxes that they can pay. But I know for sure major corporations such as Walmart and Target, they are so way up there that they cannot be able to establish themselves as an S corp. They have to do a C corp because they're making so much money and they're being really profitable and they have 1 million employees. It's only works in their benefit to be a regular C corporation. Okay, so that is the advantages of being a corporation, right? A few disadvantages it's going to require a lot of time and money to establish a corporation. So again, I've talked very, very briefly about this. What it means to take time is you can't just dive right into a corporation right away. You need to start from square one, which you either decide yourself as either a sole proprietor, a partnership, or a limited liability company. You need to start from a smaller company and build yourself up to become, a company that's that people want to invest in, So it does take time, and again, you have to file through whatever state that you want to put the headquarters in order to be incorporated. So, and it does require a lot of money to establish a corporate status. Okay. Number 2 is you're being monitored by the federal government and agencies to follow regulations. So we'll talk about this in a second, but thanks to Mr. Enron, and we'll talk about that in a second. Mr. Enron is the reason why we have the Sarbanes-Oxley Act, and it's the reason why the government is now involved in every corporate decision. They're looking at them in a microscope view, looking at places that the corporations can possibly have fraud, and we'll talk about that later on. Okay, so with that being said, that means that every decision that they make, it has to be reported to the IRS. Every single report needs to be reported to the IRS and needs to be double checked, and audited. So there's a lot of disadvantages, especially if you have the government controlling majority of your decisions when it comes to doing corporate status. Okay. And then lastly, number 3 is you get higher taxes and are taxed twice. So again, if you're unable to establish yourself as a S corporation, unfortunately, you are subject to be a C corporation, which you will be taxed twice. And depending on how much money you profit, how many employees you have, it's going to be a whole lot of money. Okay? Any questions in regards to corporations?
How you become a shareholder?
How do you become a shareholder? You buy their stock. So if the corporation is already established, right? If it's a company that's already incorporated, what's going to do is you go to the stock market and you buy whatever stocks that's available to you. So, for example, I believe like Apple or Tesla, their shares is about like $100 and something right now. So they're very expensive to own one stock. Okay, so that's how you become a shareholder, is by purchasing a stock from the company's stock at the stock market. Okay. Any other questions? Okay, we got 2 more entities left, and then we'll take a break after this. So let's go ahead and dive into the last 2. So limited liability company. Okay, so what is a limited liability company? It is actually it's a mesh between a corporation and a partnership. Okay, so what do you mean? So it's basically a mix between them. Now, a few things: that it's not a corporation itself, but it is a legal company that does not, there's a few key features that is corporate like, but it's not technically, because if you establish yourself as a corporation, you need to have all 4 criterias, all 4 characteristics. So as a limited liability company, you only seek 2 characteristics of a corporation. So again, let's look at the 4 different corporate characteristics. So it needs to be either or. Either you have shareholders, either you have a central government or a central management, you have some way to means of distributing your profits, either through dividends, and or you can have a continuity life as long as you have one person involved. So as a limited liability, they're more likely to be either either they have stocks and they distribute through the dividends, or they have a central management that runs the company, and who runs it is your shareholders. So it only carries at least only 2 characteristics of a corporation, but it's not fully a corporation, but it is a legal company. Okay? Now, advantages and disadvantages to that kind of company is, number 1, that that taxation, you can be taxed as a S corp. Okay, so you can be established at a when you pay taxes, it will be at the corporate level. So you could get an advantage there, because you could be an S corp, right? Only taxed once. Number 2 is your limited liability, meaning because you are technically a partnership that's a part corporation, with the partnership, you are free from any responsibilities if in case your company goes into a lawsuit. All of your personal assets are safe. Okay. The only thing that you would be more liable for or responsible for would be your original investment. Okay. Number 3, can elect one member to be the entity. So very similar to a general partner, right? Or I'm sorry, yeah, it's very similar to a general partner in a limited liability partnership, right? You can elect one person to be the entire business, okay? Or you can have them run the business while your silent partner, they just invest the money, okay? But in this case, we're establishing it at a corporate level. So that is an actual good advantage, is that you can have one person run the business, but again, they're not responsible for any faults that the company does, especially if there's a lawsuit going on, okay? Number 4, no annual shareholders meeting is required. So again, if you do potentially have stockholders or shareholders, right, you release stock so you can receive funds. It's not required to have a shareholders meeting, okay? So you don't need to involve everybody because again, you guys are a partnership. And then number 5 is less administrative work is required for record keeping. Okay, so again, because you are a partnership, there's not really much there's not really much work or anything that you really need to keep records for. And then lastly, number 6 is members' interest can be assigned. All right. So again, if you partnerships, right, could be 2 or more people, you can have a central management, which could be your members of your company, and you can establish specific tasks, or they can be assigned a specific role. Okay, so that's pretty cool about that. All right. Disadvantages of being a limited liability company is, of course, you have to have at least two members or more. Okay. Again, we talked about this. Establish yourself as a partnership. You need to have at least 2 or more people. If you don't, then you become a sole proprietor. So that is a disadvantage, is that you cannot continue doing business, especially if you establish yourself as a limited liability company. You need to have another person involved in this organization. Number 2, can have limited life span. Yes, again, if a partner leaves, your business can disappear. All right. And then may have self-employment taxes. So this one is mostly for, especially when you are a partnership, you can report as you're being self-employed, or fill out your 1099. But this one's a little more vague on my side. But if you are interested in learning like real detail, if you do plan on establishing yourself as a limited liability company, the best resource is to go to irs.gov. They'll give you every single thing about the business and how to file taxes, especially for this kind of entity. Number 4 is if profits exceed 50%, it will be taxed. Okay, so again, remember, because corporations, one of the disadvantages of being a corporation is that the government is involved. So if you establish yourself as a limited liability, you are part corporation, right? So therefore, the government's hands are also involved as well. So here's a good little fun fact, that if your company makes more than 50%, half of that money is going to get taxed. Okay. Number 5, cannot take advantage of stock options. So this is more for benefits. So when you become part of a company, So especially as a limited liability company, you are technically a partner in this company. So as a partner of the company, you cannot actually own your own stocks. Is that crazy? Because I mean, honestly, you can just take money out of your own company. It's your company. You're established as a partnership, and you invested your own money in there. However, you cannot own your own stocks. And then number 6 is some states tax LLCs. So I know for a fact that the state of Nevada does indeed tax LLCs, but you could, of course, before establishing your business, you may want to look into which states actually tax LLCs and don't tax LLCs, because this could be a benefit or a disadvantage to you. So again, I know that most states, they do tax LLCs. Okay. And then lastly, number 7, converting an existing business into an LLC can be taxed for applications. So again, you can start your business off as an LLC, but if you started yourself off as a regular partnership and then you incorporated your company to get that LLC status, then yes, there is a penalty fine for that, or you do need to pay a little convenience charge, we'll call it, to apply to become an LLC status. So yes, that is a disadvantage. All right. Any questions in regards to limited liability companies? No? Okay. Let's go ahead and move on to our very, very last section, which is actually one of my favorite sections. All right, it's going to be nonprofit organizations. Pretty straightforward. There's a bunch of them all over the U.S. Other common ones are going to be PETA, not us PETA, but animal PETA, okay? And then we have Comic Relief for AIDS. We also have St. Jude's for cancer, and also, Susan G. Komen for breast cancer. So these are typical examples of nonprofit organizations. They do not, their main purpose and goal for establishing yourself as an organization is not to make money. It's to actually spread awareness. Okay, so but it doesn't mean that you can, for example, I believe Susan G. Komen, they sell their T-shirts to raise awareness, but also to raise money for their organization. So that's primarily what they do. They don't raise money to make a profit. They raise money to help them get the resources, materials, and things to educate and spread awareness. So again, these type of organizations can be or not limited to. Obviously, they could be for charities. They could be to provide educational purposes for culture, or even professional religious beliefs, et cetera. Okay, any kind of thing that kind of provides a service, okay, to spread awareness and to educate. Okay. Of course, there's absolutely no owners when it comes to a nonprofit organization, and it's purely based on volunteer work. Okay, so that means if you want to become a member, you're purely volunteering yourself to this organization. If it's something that you believe in, then that's exactly how nonprofits gain their members. Okay. Now, most times, when it comes to nonprofit organizations, is that it's typically funded by the members itself. right? If you want to be part of an organization, you have to do membership dues, okay? Other things too is it could be from contributions from other other people, other places, or if you have a GoFundMe kind of account, something like that, right? They have an official website that you can donate to, so people can contribute to their to the organization. Okay. Other things too is most of these nonprofit organizations, they like to partner up with other actual legitimate corporations, companies, to help them have to spread awareness, but also to run a fundraiser every year to raise money. So one that always happens is the LA AIDS Walk. If you guys ever done that before or heard of it, it's where they shut down the whole street of LA, and what they do is they have people participating in it, and what they do is they walk, and for the block of hours that they walk, they have a whole bunch of other contributing companies that helps raise awareness. And most people, what they do is they go on the website and donate to this organization or sponsor a person who's running. Okay, so they find some kind of way to raise their money for the ultimate goal, which is to spread awareness. Okay, and then obviously some businesses or some federal states, they kind of want to be charitable or look charitable, so they start writing big fat checks to these organizations. So you get the point. So again, they're not for profit, and lastly, they have special taxes, especially because they're not earning money to make money. Okay, they're earning money to get the supplies and the necessary needs to create the marketing material to spread awareness. So they actually get special taxed. And all that details, it's actually a lot more complicated than a regular person that gets taxed at a corporate level. It's completely different. And the best way to understand if you do want to potentially become part of a non-profit organization is to go to irs.gov, because they will give you the guidelines on how non-profit organizations actually get taxed. Okay. Any questions in regards to organizations, business organizations? No? Okay. Okay. All right, so it's actually quite early, so I'm actually going to continue. Our scheduled break is at 10 o'clock, so I'm just going to go ahead and continue, and we'll take our break at 10 o'clock. Okay, so now that we learned all those business organizations, now we're going to talk about business activities, because this is very, very crucial on the reason why we even establish business organizations in the first place. So there are a total of 3 different types of business activities, okay? Number 1 is service, okay? Service is actually one of the most widely used ones that we have established as business organizations. Reason being is because, for example, service, it's not something you provide a product and you sell it. It's more for people providing their time, right? So usually service-based or companies or organizations usually entail like a telephone company, right? They don't have a product to sell to you, they have a service that they sell to you. Okay. Other things too is, for example, since we were talking about accounting, we have tax people, or you go to the IRS, or not IRS, you go to H&R Block. You spend an hour with a professional accountant. That is not a product they sell, it is a service they offer. Okay, it's their time that they take to go over your books, and you pay them for that specific for the time that they invested. Okay. The second one is the most biggest and common one that you'll see most often. That's actually more visible, which is going to be merchandising companies. Okay, so merchandising companies is pretty straightforward. It's anything that sells a product. So most often that you'll see is retail stores, wholesale stores. Okay, so again, retail stores could be limited or beyond, right? Anything that sells a good to the public. So it could be Walmart, Target, a clothing store, you know. It could even be a mom and pop's food restaurant. Anything that sells a product. Okay, so pretty straightforward, this kind of one. And then wholesale, okay, where they sell goods in large quantities. So example, Costco, Winco. Those are things that they sell. They kind of package it for you, and they sell the same products, but instead of at an individual level, they sell it in bulk. Okay. And then lastly is our manufacturing companies. Okay, so this is pretty straightforward. Manufacturing is they actually make the product at their company, and then they sell it to either the retail or they actually sell it to the public at an individual level. Okay, so again, for example, a car dealership. Okay, not only do they make the product, they also try to sell the product to the public. Okay, so again, these are pretty much the three typical ones that we're going to be looking at. However, for the focus of our class, we are actually going to be looking at merchandising company. Okay, we're not going to sell a service, we're going to sell a product, and that's going to be coffee. Okay, we're going to be looking at our fictitious business as Coffee Cafe, and our main focus and goal is for selling coffee. All right. Now, the next part is going to be accounting. All right. Well, what is accounting? It's pretty straightforward. It's the systematic processing of analyzing, recording, reviewing, interpreting financial information. Okay. In another sense, the way to look at this is you're kind of taking financial information and you're answering these questions. You're answering what happened, when did it happen, why did it happen, and how did it happen. Okay, so for example, I went to the grocery store and I bought food. Well, what happened? I went to the grocery store, I bought food. That's what happened. When did it happen? Yesterday. Why? Because I'm hungry. Okay, and how? I paid cash with it. Okay, so pretty straightforward. So this is going to be very key, especially when we move on to chapter number 3, which is tomorrow, when we understand how to take a transaction and how we interpret it and how do we categorize it and sort the data. And also the one thing that we want to make sure is, how does this transaction affect my business? That's the number one question that you need to ask yourself every single time when you look at a transaction. Okay, so again, it's going to ask you the what, the who, what, where, who, what, when, and why, and how. Okay, so understanding that. Now, another thing I want to also tell you that the financial information is used and measured for the sake of either internal users or external users. Internal users are people who are inside your company. So all your employees, all your profit managers, all your executive vice presidents, whatever it is, right? It's people who are involved in your company, okay? And the other one is going to be your external users. So people who are interested in possibly investing into your company. So bank lender, bank people, right? lenders, stockholders, all those people who are interested and want to invest into your company. That is exactly what your financial statements are going to be produced for the external users, especially people who are already invested in your company. A good way to let them know that this is a good decision that you invested in the company is giving your financial report. Did I make a profit this year? Then your external users will be like, yes, I made a good decision. And if you show them that you made a loss this year, then maybe that external user might, think about investing their money in somewhere else. So that is exactly what the financial information is primarily geared towards, is internal and external users. Okay? So the next part is going to be understanding the difference between a bookkeeper and the accountant. Okay, so if I had to give you a 5-second rundown between the difference between the bookkeeper and the accountant, the bookkeeper strictly records transactions. The accountant does everything else. The accountant can record the transaction, they can analyze the transaction, they can make reports and financial statements about the transaction. They can also build projections, outlines based off of that transaction. And they are the ones who make the rules for the bookkeeper in order for them to record the transactions. So basically, the accountant is the boss. And then the bookkeeper is simply the employee. They're just instructed to do one task and one task only. Okay? Now, break it down to real seriousness. Bookkeeping, like I said, their main priority goal is to just take a transaction, look at the transaction and see if this transaction is even worth recording. Now, what will happen is the accountant will collect all that information and pretty much give it to the bookkeeper and say, record all this transaction. That's generally what would happen, okay? And so the bookkeeper, all they're strictly doing is they're given a chart of accounts, which we'll talk about. They're given the rules of how to journalize, and they're given the materials to journalize. So the books that they have to journalize in, and basically the transactions, journalize this, okay? They cannot analyze the stuff. They cannot tell the accountant, hey, this profit margin looks really off, okay? So they cannot do any of that. However, of course, they do have the power, because they're the ones that are recording, is if there's a mistake in there, they can go to the accountant and be like, I think this is a mistake. There's a discrepancy. There's something wrong with this transaction. Yes, they can do that. Okay? So the accountant, on the other hand, they're the ones who create the chart of accounts. They're the ones who create the rules and how to journalize. And they are also the ones that gets to interpret. They're the ones that makes the decision, is this a transaction that affects the business? And if it is, then I'm going to give it to my bookkeeper to record. They are the ultimate person that does majority of the work. And in this class, not only am I going to teach you to become a bookkeeper, I'm also going to teach you to become the accountant as well. And we'll talk about that when we dive right into the fictitious business, the coffee cafe. Okay, so the first 2 weeks you're gonna be the bookkeeper. The last 2 weeks I'm gonna give you the reins, and you're gonna become the accountant. You're gonna make the executive decisions. Okay, so yes, that is that. Okay, so actually I'm gonna go ahead and call break here. And then we'll come back and talk about the rest of the different types of accounting, as well as finish up chapter 1. Okay, so right now it is exactly 9:50. Let's do a 20-minute break. So please be back by 10:10.